The greatest gains in REIT investing come from buying shares of a company that's priced for a likely bankruptcy, only for it to defy expectations, survive, and eventually return to a more typical valuation. A great example of that is the case of NAREIT. The mall REIT was over-leveraged heading into the pandemic, and it caused its share price to crash all the way down to $5, which represented an 80% discount to our estimate of its net asset value. A few other mall REITs had already filed for bankruptcy, and the market feared that NAREIT would be next. In that scenario, the equity would have likely been wiped out and no share price would have been low enough. That is why it was priced at such a huge discount. But while the risks were high, we thought that the market had overreacted and the risk of a bankruptcy was far lower than what the market had priced in. This pushed us to buy a lot of shares at right around $5 per share in March of 2020, allowing us to average down our cost basis all the way down to $8 per share. Now, 4 years later, we are happy to look back and see that we are right. The company managed to survive the pandemic, it improved its balance sheet and eventually regained a more normal valuation, leading to a quadrupling of its share price. I'm only bringing this up because I think that several other REITs find themselves in similar situations today and could see their share prices triple or even more in the coming years. Hey, this is Yussi. I run a small investment firm that specializes in REIT investing, and before going to today's video, I want to remind you that the investments that I'm going to present are speculative. You don't get the prospects for a doubling, a triple, or even a quadrupling of the share price without taking significant risks. These companies are very speculative. They could go bankrupt, and in that scenario, you will likely get your equity completely wiped out. But we think that the risk to reward is attractive here as part of a well-diversified portfolio. These are small positions for us, and so if they go bankrupt and the share price goes to zero, we'll still manage to bounce back from there. They're relatively small positions, but we think that it's more likely that they will survive and eventually see significant upside, which could significantly boost our portfolio performance. Okay, so the first company that I'm going to discuss here is called Branicks, ticker symbol BRNK. This is a German landlord that's today priced for likely bankruptcy, trading at an 85% discount to its net asset value. Risks are very high because it has too much leverage, its debt maturities are approaching, interest rates have surged, and selling assets have been very tough in today's market. But as we've explained in an earlier update, we think that the probability of a bankruptcy has been mispriced by the market. While it's certainly possible, we think that it's much more likely that the lenders will work with Branicks, give it more time to sell assets, and pay off its debt. In case you're not familiar with this company, I would recommend that you start by reading this earlier update. I'll put a link to it in the description of this video. This is completely free, there's no paywall, it will redirect you to Hired Landlord. You can read this update for free and then come back to this video. Okay, so now that you're familiar with the background, let's get to the latest news. The big news is that the lenders have agreed to extend the debt terms and also relax some of their loan covenants to give Branicks more headroom and time to sell assets and repay its debt. And since then, the company has managed to sell many more assets and it has allowed them to repay their bridge financing well ahead of schedule. This has brought down their loan-to-value from 57.6% down to 55.3%, leaving more headroom on their loan covenants. They think that at this pace they will manage to bring down their loan-to-value below 50% within a year from now. And I think that they're likely to achieve this target because they're earning significant cash flow that they are retaining to organically pay off debt. Now the transaction market also very clearly recovering as evidenced by their recent transactions. And finally, we also expect cap rates of their properties to compress a bit following all the recent rate cuts. And if I'm correct about this and they manage to pull it off, then I would expect the share price to rise very significantly because it would materially reduce the risk of the company going bankrupt. The company will still deserve to trade at a discount valuation, but even if its share price doubled from here, it will still trade at a 70% discount to its net asset value. If it tripled, it will still trade at a 50% discount. The company now seems so confident that they will pull this off that they've switched from talking about short-term survival to talking about mid-term growth ambitions with this new chart that they added to the investor deck. They just recently also announced that they are launching a new $300 million fund focusing on renewable energy investments. It would be very unusual for a company that's about to go bankrupt to launch a new fund. Their mid-term ambition is to become a major asset manager in the renewable space in addition to their industrial and office real estate. It's easy to forget this, but until the historic surge in interest rates, Branicks was actually very successful at raising funds and was rapidly growing its assets under management and the fee income that comes with it. If they survive this tough period, strengthen their balance sheet, and return to growth by reinventing themselves as an ESG-focused asset manager with significant renewable energy exposure, the stock price could more than quadruple over the next 5 years, just like NAREIT did following the pandemic. As I've said earlier, the risks are very high of course, but the reward potential is so significant that we like the risk to reward as one position as part of a well-diversified portfolio, and for this reason we've kept buying more shares of the company for our international portfolio. By the way, if you want to access our full REIT portfolio, you can join us for a 2-week free trial. There will be a link to it somewhere in the description of this video. Also, if you enjoy this type of content, please show your support by clicking the like button and subscribing to the channel. It helps me a lot to keep on growing. Thank you very much. Okay, so the second company that I'm going to discuss is called Medical Properties Trust, ticker symbol MPW. Let me start here by emphasizing once again that Medical Properties Trust is very risky, just like NAREIT once was. This REIT specializes in hospital property investments, and this is a struggling property sector with weak tenants, frequent lease defaults, and unfortunately for Medical Properties Trust, it's too heavily concentrated on a few struggling tenants, and it's also over-leveraged. This is a bad mix that could force it into bankruptcy. The company has significant debt maturities coming its way, it's forced to sell a lot of assets to pay off debt, and this is reducing its cash flow and dividend also in the process. Its loan to value is in the high 50s, so quite high, and it will almost certainly need to refinance this debt at a lot higher interest rates if it's even able to do so. But there's still some hope. The company just recently resolved its biggest problem, which was the Steward bankruptcy. This was the REIT's biggest tenant by far, representing over 20% of its rental income, and it has not earned anything from it in a while. But it has now managed to release 15 out of 23 hospitals leased to Steward. The new operators of these properties will start paying rent in the first quarter of this year and ramp up to their full rent level by the end of next year. And the great news here is that the full rent level for these 15 facilities represent about 95% of the level that Steward was paying on its original lease. Many analysts, including us, fear that Medical Properties Trust will have to give steep rent cuts in order to release these properties, so this is very good news. But the REIT's issues do not end there. Just recently, another one of its tenants representing about 7% of its rental income, called Prospects, also filed for bankruptcy. Now, to be clear, Prospect has not paid any rent in June 2024, so the bankruptcy is not really coming as a surprise, but nonetheless, it reminds investors that Medical Properties Trust has more than one struggling tenant. Will it manage to limit the damage by releasing or selling some of these properties? If yes, then the cash flow will bounce back to higher levels and the REIT should be able to address its near-term debt maturities. In another recent update, we guesstimated that the REIT's annualized funds from operations per share would settle at around 85 cents per share. But truthfully, it's very difficult to predict exactly where Medical Properties cash flow will bottom out because the tailwind of slowly ramping up the rent collection of former Steward hospitals will be offset by having to sell more properties to pay off maturities and also rising interest expense. But in all likelihood, we think that the FFO per share of the company will be somewhere around 80 cents to $1 for the next few years. If we now look a few years out and assume that the company has managed to address its tenant issues, deleverage a bit, extend its debt maturities, and remove concerns of survival, then it could regain a 10-time FFO valuation multiple, and this would result in an $8 to $10 share price. That's about 3 times more than today's share price, and so, yes, the risks are very high, more challenges lie ahead for Medical Properties Trust, but if it can address those issues, the upside could be very significant in a few years from now. Final warning, these are very speculative investments, they could go to zero, especially if we are hit with another black swan in the coming years, so size your positions accordingly and only invest if you have a high risk tolerance. And also make sure to diversify, these are just 2 positions as part of a well-diversified REIT portfolio that's mostly invested in solid long-term compounders like Essential Properties Realty Trust, Vichy Properties, and so on. If you want to access this full portfolio, there will be a link to a 2-week free trial in the description of this video. You won't be charged anything for the first 14 days. You can cancel anytime, no questions asked, but you can join us for a free trial, see our portfolio, read our research, access our exclusive CEO interviews, and if there is enough value for you, you can then stick around and invest with us. But if not, just cancel and no problems. Again, thank you very much for your interest. If you could please click the like button, subscribe to the channel, that will help me a lot. See you at my next one. Bye-bye.